Hello, welcome back to this week's market update. Today is Tuesday, February 18th, 2025, and with that, we will jump right in. Jumping right into our weekly performance here, markets posted gains last week despite hotter than expected inflation data as well as weaker than expected retail sales data, but investors were calmed by the apparent delay of additional tariffs. As of close on Friday, February 14th, the Nasdaq Composite rose just shy of 2.6%, while the S&P 500 was up about 1.5%, followed by the Dow Jones Industrial Average up a little more than 0.5% on the week. Bonds also saw minor gains, with the Barclays Aggregate Bond Index up 0.23% as of close on Friday last week. Now, taking a look at the hotter than expected inflation data here, we got the January CPI and the PPI here, the first inflation metrics of the new year. Annual headline inflation rose to 3%, while core inflation was slightly higher at 3.3%. Headline inflation was up about 0.5%, while core prices were up about 0.4%. So both accelerations in the speed of inflation, especially on this headline metric. You can see we got pretty close to 2% here a few months ago, and we've been rising in recent months. So some of this might be more transitory, might be due to things like food prices. We know egg prices are up quite a bit, as well as energy prices have also risen in December and January. So several factors at play here, but in the next slide, we'll take a look at the categories within inflation. Looking a little bit closer at the categories within the CPI here, you can see, as I was saying, groceries were up 0.5% in the month of January, largely driven by a sharp rise in the price of eggs, which were up over 15% in the single month of January, which is the highest monthly gain in egg prices since June of 2015. So nearly 10 years since inflation has been this high for egg prices. However, we do expect that to come down within several months, 6 months or so, depending on the supply of eggs as the avian flu hopefully gets under control in the coming months. Other categories here, you can see fuel oil, that was up quite a bit, about 6% month over month there. Gasoline also up quite a bit, 1.8% month over month. Other categories like apparel were actually down quite a bit as companies marked down apparel prices after the holiday season. Finally, other things like shelter and transportation services continue to be pretty sticky there. You can see transportation services were up nearly 2% in the month, 8% from a year ago, while shelter prices were up 4.4% from a year ago. And this is one of the stickiest components that we've been dealing with within the CPI as housing prices remain pretty sticky and mortgage rates remain high. Our other inflation metric, the PPI, the Producer Price Index, otherwise known as wholesale inflation, also came in a little bit higher than expected. Headline prices rose 3.5% from a year ago, while core prices were up 3.4%. On a monthly basis, this was a 0.4% increase in headline and a 0.3% increase in core prices. So both accelerating on a monthly basis here, pretty in line with December's monthly rates, but it has been rising. You can see we were in the low twos on that headline inflation rate, and now we're up to 3.5 now. So it is rising quite a bit there, but that comes down to a abrupt jump in the price of foods, which were up 1.1% in the month to producers. Energy prices also up 1.7% in the month there. And then other things like transportation and warehousing, which is largely reliant on energy prices there, that was also up 0.6% in the month of January. So overall, it is going to be harder for the Fed to cut rates in the near term. They may decide to hold rates higher for longer in anticipation of possible inflation coming from tariffs, as well as this current data that has been showing some stickier, more inflationary signs in recent months. So we'll just have to wait and see how the rest of the year comes along with inflation data. Does it stabilize or does it continue to rise? We're not sure, but we will continue to monitor and adjust appropriately. In addition to the inflationary data of last week, we also got a bit of a slowdown in retail sales figures in the month of January. So it came in lower than expected at 723.9 billion, a drop of almost 1%, about 0.9% from the month of December. However, we did see December's numbers upwardly revised to an increase of 0.7%. So that contributes to part of the decline here, as this is a higher number in the month of December, which causes this to be a greater drop when it is lower on a month-over-month basis. We also saw categories like auto that declined 2.8% in the month, and so that also put quite a bit of a drag on January's retail sales numbers here. Last but not least, we got the quarterly survey of professional forecasters, otherwise known as the Anxious Index. Anxious Index measures the probability of real GDP declining in the next quarter. Typically, when it is above 40%, that is a recessionary indicator, and it got pretty close to that a few quarters ago. But in this most recent revision from last week, we had the probability at 15.4% of a recession in the next quarter. So that's pretty low there. It's a positive indicator from 40 professional forecasters that do this for a living. When we look at other forecasts here for other variables, we can see real GDP growth. That was revised upward from 3 months ago. Now economists are estimating about 2.4% real GDP growth in 2025. They revised the expected unemployment rate slightly lower, and then payroll growth that was revised up to slightly better. So they think that the economy is going to grow slightly better, and unemployment's going to be slightly lower than expected, and the rate of employment growth is going to be a bit higher than they thought 3 months ago. So overall, a pretty bullish reading here from the survey of professional forecasters. Although again, this is just one survey of many, many economists, not to be a telltale sign of what is to come. It's just one estimate of what may be ahead. So with that, we just want to say thank you for tuning in, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.